Hi everyone, thanks so much for joining today. My name's Eva, I'm a fund manager at M&G Investments. Today I'm going to talk you through a bit about sort of how I got to the role that I'm doing today, what my day-to-day job looks like, a bit of background on me, and also what we're now looking at in the funds, market themes and areas of interest, as well as sort of the more day-to-day runnings of the job as well. So a bit of a summary of me as a person. So I went to the University of Birmingham, got an economics degree, joined M&G on the graduate scheme in 2018. Prior to that, I did some work at State Street Global Advisors, working on ETFs and passive strategies. So that was super interesting, but wanted to get more exposure to the active side. And so I joined M&G in 2018. On the grad scheme, which was great because it allowed me to rotate across the whole business. So I did rotations in real estate, long-term investment strategy, corporate credit research, emerging market debt. So it really gave me a really good overview of the business and a really good wide remit from which to learn from. I then joined the M&G wholesale fixed income team in 2019 in September as a junior macro fund manager. So this involved implementing macroeconomic trade ideas across a wide range of funds, so both absolute return strategies, the global macro bond fund, emerging market funds, etc., working on both developed markets, emerging markets, some credit, very top down, but also utilising the sort of wider team for the bottom up analysis. So we have not only do we have our wholesale fixed income team that includes fund managers and investment specialists, but we also have a wider fixed income dealing team, as well as a credit research team full of analysts. And so there's daily meetings, and it's a really broad spectrum of which to learn from and to communicate with and work with day to day. So super interesting, a lot of fun. Obviously the pandemic has thrown a bit of a spanner in the works in terms of everything now having to be virtual, but the dialogue is still very constant, and it's been great for me to learn from and continue to sort of build up my expertise and continue to add value to the funds that I work on. As of January this year, I was made lead manager of the M&G Global Government Bond Fund, so investing across mostly sovereign bonds in both emerging markets and developed markets, some quasi-sovereigns as well, or any government guaranteed corporates, that sort of thing. And we also do FX, the Global Macro Bond Fund, which is the fund that I now deputise on, which was also implemented in January, invest across almost all of the fixed income universe. So we look at credit, government bonds, high yield bonds, emerging markets, developed markets, ABS, FX, sort of anything you can think of, we probably do it. So that's also been a great one to learn from, and to be now a deputy on has been great. And I'll talk a little bit more about that later, and sort of what we do as a team, how I work with Jim Levis, who has been in the industry for about 20-something years. So he actually joined M&G and started running this fund the year after I was born. So we're completely different ends of the spectrum, but the way that we work together has been great, and we, bring lots of different views and different perspectives, and that's probably true of the wider team as well. So as I said, what I'll sort of aim to sort of do today is give a sort of insight into me and my background, the day-to-day role that I do. We'll also talk a bit about big market themes, how the portfolios are well positioned for the current environment, which is a very unique environment, and how the flexibility of those sorts of portfolios have been, in my opinion, crucial in terms of trying to generate outperformance in an environment that is notoriously detrimental to bond funds. So what I'm talking about there is inflation. So I'll talk a little bit more about that later as well. So if I just rewind to a bit of a background about me. So as this says, I come from a family of medics and engineers. Both my parents are intensive care doctors, which has been an experience of itself through the pandemic. Obviously, it's been a very interesting time for them, but it's something that I don't have any idea about. It was never something that I wanted to go into. All of my siblings, I'm one of 4 siblings, they're all either engineers or medics. So I was the anomaly going to university to study economics. But for me, it was something that, I always really liked maths. I always really liked economic history. and that sort of thing. So it suited me really well. Whilst at university, I got involved in all sorts of things. So I was the president of the Economic Society, which was actually great because it allowed me to go to loads of careers fairs and corporate events and get a really good insight into sort of the life after university and what I was going to do. As I said, I worked at State Street for a bit, so I did that over one of my university summers. So that was a 3-month placement, gave me a really good insight into the industry. I also did a lot of sort of weeks here and there. So I was at Morgan Stanley for a bit. I worked at McKinsey for a bit, just to try and gain as much of a broad understanding as I could of the industry. I think there's a lot of, the industry is known for not, sort of running in families in terms of, when you have someone in the industry that you live with or that you talk to on a regular basis, you get a much better insight in terms of what is what and who does what and what's an investment bank and what's an investment manager. Whereas I didn't have any of that because all of, my parents were doctors. I had no contact to the industry whatsoever. So I had to go out and try and find for myself what on earth any of these words meant, what the options were to a university student. And then obviously decide what I liked and what I wanted to do. And there's also a slide in here about my martial arts background. So that's something that has been a big part of my life. It feels a bit random on this slide, but I thought it would be worth mentioning just so that got to know me a bit better. So I was actually still am technically a black belt in jiu-jitsu. I was a British champion and international champion for under 18s girls. So that's something that has shaped a lot of probably how I look at the world and life. And, I think it helps with discipline. I think it helps with teamwork. I think it helps with, a lot of those skills that you do in extreme sports or in sort of sports that you play at a high level, you can also transfer into your daily life. And it's something that I get asked about a lot. And it's something that, I would actually recommend to anyone if anyone wants to try a new sport out. Jiu-jitsu is brilliant, not only for the self-defense aspect, which is what you associate with martial arts, but, if you have any kids that you want to send there, it's great to learn respect and teamwork and all of those things. But for me, it's really sort of shaped a lot of how I probably analyze things and work with people and, push myself if I'm in a high pressure environment. So just thought I'd give a bit of background on that. So as I said, I've come into the fund manager job at a very interesting time. So in January of this year, would say it's been a bit of a baptism of fire. Jumping in to run a global government bond fund at a time when we've just had a year of extremely low rates. So that would have been 2020. And now we've got a situation where markets pricing in tapering. So government bonds are selling off across the board. Global rates are, global yields are up. We've got equities doing very well. We've got a potentially reflationary environment, which is bad for bonds, especially government bonds. So for me, it has been a complete baptism of fire, but also has been tremendously helpful in terms of learning as much as I possibly can, especially given it's such a unique situation. So the other blocks on this slide, so I was a junior fund manager first. So that was over sort of 2019 and 2020. So I got some peace before the storm in 2019. So that was where I said I worked across a broad range of funds. And then I was still a junior sort of in March 2020 when we then went into the pandemic and everything kicked off. And so I think for me, the pandemic has actually been something that has, as horrible as it's been, and, something that has thrown all sorts of personal and professional challenges at us. For me, I probably wouldn't have progressed as quickly as I have without having been thrust into that ridiculously high pressure and, intense environment where markets were just completely blowing up. It allowed me to, you don't get that benefit that you often get as a junior where you sit between experienced people. You get to learn almost by osmosis. You get to hear the conversations that happen next to you or behind you or whatever. And I couldn't have that because obviously we were all at home, working from home. I also went back to my parents' place for lockdown. So I was also dealing with, having to also try and balance living with 2 intensive care doctors that were under a tremendous amount of stress themselves. So I'd actually say that the pandemic made me really step up. I had to be value without having that extra assistance that you get from being in an office. So, there were lots of challenges, and you have to learn how to communicate with people virtually, which everyone has had to do. You have to learn how to try and share your investment ideas. Even you have to become a bit of a tech expert, because there's all these problems that you face with VPNs, or trying to log into remote systems and all this thing. And it ended up being, I often became tech support in this situation, because a lot of my team are a bit older than me and not quite used to that sort of setup. So lots of challenges, but also something that I think has been fundamentally probably quite helpful to me. I don't think I would have been put on as lead and a deputy by this point had I not had to completely step up my game because of the pandemic. So if I talk a little bit about my day job, so yes, as this slide says, so my primary day job is to run the M&G Global Government Bond Fund. Now, what this looks like is a wide remit of research, for one. So I'm constantly reading research pieces. I'm constantly attending meetings with government ministers, or with the IMF, or sell-side strategists, that sort of thing. In a lot of those sorts of meetings, we'd obviously trade day to day. So if you have a sort of more vanilla sort of trading, which is where you either say you get an inflow and you need to invest that cash, or you have an outflow, you need to raise cash. We have new issues that come every single morning. And so you see who is issuing, whether you like the bonds, whether you like the credit, whether you think that it's trading at any sort of discount, that sort of thing. So you have the day-to-day trades. You also have the trades that obviously you put up because you think that there's an increase or decrease in relative value based on credit fundamentals. So that's the more probably interesting trades that we do. So that will be if I've attended, for example, a meeting with the Central Bank of Indonesia, and I think that actually markets are probably overpricing their hawkish stance, or underpricing, whatever, then that's something that we then would like to trade on, because we believe that there's a misprice in the market, or we believe that markets are being inefficient, or we're just generally more bullish or bearish on a particular name, country, environment, credit, that sort of thing. So Jim and I work in a really good way, as I sort of alluded to earlier. I sort of come in with more of the sort of bottom up for day-to-day sort of views. I specialise on Asia specifically. So in our emerging markets team, for example, we have strategists that look at Africa, Latin America, Central Europe. And so I focus more on Asia from the bottom up perspective, but we also combine a lot of top-down analysis as well. So Jim and I constantly talk to each other. Obviously, he has a wealth of experience, and so he tends to make the big calls in the Global Macro Bond Fund. The Global Government Bond Fund is a little bit different, so obviously that's where I have the final say. But he is deputy on the Global Government Bond Fund, and I'm deputy on the Global Macro Bond Fund. So basically, sort of a dream team in terms of we're a pair, and we work on both funds. And even though I'm lead on one and he's lead on the other, the dialogue is constant, and I would say most decisions are made together. Especially, for example, the bigger calls on the funds, like the duration positioning, or the broader G4 FX positioning, or the inflation holdings in the fund, that sort of thing. So I'd say most of our decisions are made together. So whilst it's been a massive responsibility for me to have to step up as a fund manager already, having only been in the industry for a few years, actually it's been tremendous, because I get to work with Jim on a daily basis, constantly learn from him, constantly have his support and guidance, while also being able to challenge with my own views and my own perspectives, and implement what I want in the funds that I run. And so it's worked really well, and it's been a super interesting time. The slide also points to other parts of the job that include client work or marketing. So I spend a lot of time doing interviews with the press, with Bloomberg, or the Financial Times, etc., where they want to hear fund managers' views, especially at the moment when there's so much talk about inflation or emerging markets, or the vaccination rollouts, or central bank movements, the normalization of monetary and fiscal stimulus, etc. So lots of press work that our press team sort of asks the fund managers to do. We also do things like we write blogs, and we have a Bond Vigilantes page that's sort of the name of our broader team, where we do webcasts and that sort of thing, write the blogs. and just general sort of brand marketing and sort of sharing views, client work. So I do a lot of client meetings as well with clients that either have holdings in the funds or are prospective clients. And so those are, they tend to come in waves. So you either have maybe 5 a week or none, but that will be completely dependent on the clients themselves and also sort of on our sales teams. And they're great because you get to also have a bit of a discussion and share your views, as well as obviously answer any questions that the clients may have about the funds. And it's something that I think at first I found really daunting, given that, you know, some of these clients had been in the industry for a lot longer than I had. But actually you realise that working on the funds every single day actually becomes your prep for these sorts of meetings. So you actually realise that you do know the funds inside out, and that I've never been able to not answer a question that has come at me. Every single question I've been able to answer, because actually working on the funds every single day is the best possible prep. Okay, so as promised, I said I'd talk a little bit about the key themes in the markets, what we're looking at in the funds, and a lot of this corresponds over both the Global Macro Bond Fund and the Global Government Bond Fund, given that I'm more macro focused on both. I do a bit of credit work as well on the Global Macro Bond Fund, but this is mostly very much from the macro point of view. So this first slide obviously shows 30 years of falling Treasury, bond and gilt yields. And so to put this into perspective, obviously we had a massive tightening as well of yields. Last year, central banks rushed to lower rates in response to the pandemic. And this wasn't just developed markets, this was emerging markets as well. And so for us as a government bond fund, that was great because, you know, yields are coming in. We had a very long duration position because we saw no value in credit at this point. We thought that global government bonds were underpriced. Not necessarily that, you know, we foresaw the pandemic at all, but thought that there was some recessionary signals in the market and a situation where we wanted to be long duration. And so that worked really well for us. Obviously, as I mentioned at the beginning of this year, we've had a very different situation where at the end of last year, we had Biden's victory in the US, and we had vaccination announcements, which sort of spurred markets into believing that economies would start reopening again and would start, you know, deploying, you know, the service sector money that had been saved up into economies again. And so we've had a massive repricing in markets. I'd say bond markets generally seem fairly unruffled by comments from the Fed, for example, or Yellen that rates may lead higher in the future. Markets continue to be pricing in very hawkish scenarios, but I'd say there's quite little imminent risks. I'd say there's some normalization of monetary and fiscal policy is unavoidable going forward, which is what markets are pricing in. But central banks are generally reminding us that tapering is probably off the table for now, at least for this year and potentially the beginning of next year. And that the removal of these sort of supportive financial conditions will be done via baby steps, I suppose. So, you know, if I look at the US, I'd say the main thing that the Fed wants to avoid now is market volatility, which is something that is detrimental to rates markets. This probably wouldn't stop the reflationary trend. We should continue to be supportive of riskier assets and drive curves steeper, which is what we're positioned for. Improving fundamentals and underlying economic data prints also encourage us to keep hold of our linker positions for now. As the Fed repeated, they will continue to buy treasuries and MBS until, you know, substantial improvements have been made towards their employment, price stability goals, etc. They've also been focusing a lot on labour markets and saying that they want economies to get to a certain level of employment before they're ready to start tapering. And it's something that I actually wrote a blog about fairly recently in terms of actually employment numbers haven't been great. And I think markets are actually underestimating how difficult it will be for certain sectors to get back to normal, or how, you know, people assume that it's easy to retrain into different industries, whereas obviously naturally it probably isn't the case. And, you know, we might get permanent scarring in terms of hysteresis, or, you know, those people that are unemployed that find it very hard to become employed again because they, you know, potentially have lost skills, or, you know, all sorts of things have happened over the last year for all sorts of reasons. And I think markets are not necessarily fully pricing in that level of scarring. And so that's something that, in my opinion, will likely keep the Fed dovish for now and will likely means that they hold off on their tapering. I think markets need to be careful not to assume that one good employment report or one positive inflation print will automatically lead to a massive tapering scenario. The FOMC meetings this month are likely crucial as well, as we're sort of getting to a point now where economies are starting to reopen, should generate some significant data improvements. Fed could begin to start looking at the reduction of asset purchases, etc. Vaccinations obviously continued. COVID developments obviously crucial in terms of affecting this timeline as well. Same with fiscal support as well. Vaccinations, reopening of economies will again be key, because that will determine, when we get that smooth transition between stimulus checks being spent in the US and then ensuring they don't run out, and ensuring that you then get the deployment of savings being spent in the service sector. And so I think what we need to be careful about is, as I said, that amount of permanent scarring left in the economy. It's likely that fiscal support will not reduce, but likely have to be redirected in terms of, which areas of the economy are struggling to recover. So to sort of sum up that slide in terms of the general broader environment, it's a very interesting time where, we sort of know what will need to happen in terms of the withdrawal of monetary and fiscal support. We sort of know the key risks to economies at the minute. We know that COVID variants are a risk. We know that the opening up of tourism again will be a risk to the resumption of the global economy, activating as normal. So we know all the key risks, but because of the consistent surprises the pandemic throws at us, we can't predict the timeline at all, or as accurately as we'd like to. I remember last year when we all got sent home from the office in March, and I was naive and I thought, oh no, we'll be back in May, we'll be back in June, and here we are, June of the following year, and we're still not back. So the timeline is just continuing to be very, very difficult to predict. So it's a very interesting time for markets. I think we've seen a bit of a stall as some of those data surprises have started to level out a little bit, and we've seen a bit more of an equilibrium, or markets being a bit more range bound, as I think people are trying to sort of sit and wait for the next big surprise or the next big sort of shock to the system in markets. So yeah, very interesting time. So this slide I've put in to talk about inflation. So on the left, it's an interesting one. It's a correlation between the S&P 500 and 10-year US Treasuries. So we can see that normally Treasuries are a good hedge against a falling equity environment, as in they tend to negatively correlate with one another, which is that red bit. So that's where investors seek low-risk assets in which to park their cash in times of crises. However, lately, you can see that we've got a big green line, so we've got a big positive correlation. So a big shift and decoupling of what we're used to. And at the moment, 10-year Treasury prices are positively correlated with US equity prices. Why? I guess because the economy has experienced a massive shock. A big part of this has been the comeback of potential inflation, which has made US Treasuries a bit more of an equity-like asset in terms of how break-evens are trading and how investors are starting to price in those hawkish scenarios, and rate volatility is picking up as markets try to understand what is going on. So now we have a situation where on a good day we're seeing both equities and bonds going up, and on a bad day we're seeing both these assets are falling, as investors seem to prefer cash over stocks or bonds when volatility is high. So I guess there's a lot to think about, and how do we deal with this in the funds? There's been a lot of talk about rates versus inflation lately. And in general, I'd say, we are still comfortable holding inflation protection in the funds. We believe in the near term, it's also what central banks keep saying about it being transitory. And to be honest, I'd actually be inclined to agree with that. I think underlying data prints won't actually be too reflective of the underlying economic changes for a while. In developed markets, in the funds, we generally prefer being short duration via derivative instruments, as we expect yields to continually grind upwards from here as markets continue to price in that growth and that potential central bank tapering. But yields are starting to look cheaper, and so we are gradually reducing those shorts, so not completely bearish on duration outright. In terms of inflation being a an outcome of short-term pressure, or or is it a structural shift? I think there's a lot to talk about as well, and a lot to think about in terms of the funds. If I focus on the US, judging by the moves in break-evens, the inflation story seems to be back and looks robust for now, helped by recent commodity moves too. So we had copper up, I think, about 13% in April. Oil prices and food prices are resuming their upward trends. Policy is obviously highly accommodative, as I mentioned in the previous slide. So we should get a boost, in the velocity of money from economies reopening. Savings should be deployed in the service sectors by higher earners. Stimulus checks are boosting the spending in the lower earners. And, all of these factors theoretically should ignite inflation. But in the near term, and I think this is also what Powell has been alluding to in the Fed, is that we're starting from a very low base. He was clear to explain that base effect and the current bottleneck and reopening pressures. So the Fed is stating that they expect inflation to be anchored near 2%, and also stating that the upward pressure is transitory. But clearly expectations for above 2% inflation are feeding into break-evens across the curve. And, we're starting to think in the funds now is, when do we start taking off some of our inflation-linked products? When do we start taking a few chips off the table? If the Fed thinks inflation will stay near 2% and markets think that inflation is going to be near 2.5%, and the curve's pricing somewhere in the middle, perhaps that's inflation expectations starting to be fully priced in. And so, for us, I think we've already done a little bit where we're starting to trim some of our tips. In the US, that's the inflation-linked security for US government bonds. And I think we'll likely continue to keep doing that if we continue to see this sort of range-bound effect in the break-even curve. Having said all of that, I think there are still some obstacles in place that could hinder the reflation trade in the longer term, which is why, as I mentioned, I think we're actually quite cautious and actually somewhat agree with the sort of transitory statement. I think the Fed could still surprise us in terms of intervening in rates markets prematurely, for example, through yield curve control. They've got the cost of refinancing huge debt burdens for both sovereigns and corporates. That's a problem for the global economy, is that we've got massive debt overhangs, and it's a question of how a central bank is going to be able to refinance. And as I mentioned, we've got the problem of US labour markets and those potential problems with scarring or inequality or hysteresis. That all of these factors could offset inflationary pressure. And so I think that there is a lot of structural factors in the economy that actually is likely to hinder that reflation trade in the long term. So in theory, we can reach 2% inflation again if we see those forces come together, but it's going to be hard to fight those long-term structural shifts in the economy that have driven prices lower for decades. I'm talking about globalization, aging populations, technological improvements, the rise of China as a massive industrial market. All of these factors have driven prices lower for years. So I think for us, it's very important, and I think for investors, it's very important to be in funds that can take active duration positions, that can hedge themselves against a rising yield environment, can take exposure to the reflationary environment in the short term. We're very flexible in terms of the inflation-linked bonds that we can buy, or the derivatives that we can use to add those duration overlays, or, we can move things around in terms of taking off credit risk or emerging market risk very quickly with derivatives. And I think it's key to be able to, I think it's such a good argument for why active management is so important right now, rather than trying to fight the beast of inflation and central banks and what's undoubtedly going to be quite a bad first half, if not bad year for government bond, passive products. I think it's actually crucial to be in actively managed products at the minute, where the flexibility allows you to not be exposed to all of those risks that tend to hurt bond markets. And, especially those funds like ours that can take currency risk as well, according to these, unusual rate moves, and can still diversify our risks in the FX space. So I actually also put the relationship between dollar euro and US bond rate differentials on this slide, just because with all of these rate dynamics, rate differentials are becoming very interesting and something that tends to drive currency pairs. In this current low rate environment, obviously differentials are fewer and further between, which limits the potential to benefit from carry trades and things like that. But now that central banks look to be diverging once more, there's questions of who's going to hike first, who's going to start tapering first, which should drive curves wider. Is this reason to be adding currencies in hawkish environments with the expectations that these spreads will continue to widen and provide potentially a better, return? We can see historically this has held really well between the dollar and the euro. And by the looks of the chart, perhaps it's actually time to be buying back the dollar again. So something that we look at a lot and a really interesting topic. So I've also just put this slide in because I think it's important to, we get asked a lot, as well as the flexibility and the drivers, and the derivative usage that we can do and the duration levers that we can pull. How are we going to generate alpha in an environment that is generally bad for bonds? And actually something that an asset class that we really like at the moment is emerging markets. It's very hard to do top-down analysis in emerging markets because of all the idiosyncratic risks, political shake-ups, etc. But M&G is very well placed. We have an experienced emerging market team, which includes regional strategists, so people that specifically cover certain regions, which I mentioned earlier. And we have a dedicated emerging market dealer as well, which helps make things a lot smoother because it's a very difficult market to trade a lot of the time. In general, EM spreads actually trade closer to high yield, but actually the majority of emerging market indices are made up of IG. So I think that it gets a bit of a bad rap in the markets in terms of, people assume that to buy EM, you have to be paid a much higher spread. So actually the pricing is very attractive for an asset class that is actually mostly investment grade. Also, you have the situation where individual corporate emerging market bonds tend to trade wider than their similar developed market counterparts. So, for example, a steel manufacturer in the US and Latin America will tend to could have the same rating, but you tend to have the emerging market one trade a lot wider. And obviously, this is investors demanding an extra premium for being in a riskier country. But actually, credit ratings by the key agencies actually include a premium or a discount for sovereign risk. And so actually, that steel manufacturer in the emerging market actually is likely of a higher quality to be able to get the same rating as a developed market steel manufacturer. And so for us, actually, we think markets don't price this in. And actually, you tend to get much higher quality corporates with the same ratings as a lower quality developed market corporate. That doesn't always hold, but in general, that's the theme. And so for us, actually, we can get paid very well to take exposure to a market that actually has very low default risk and actually has, we've seen lots of foreign domestic investment. We've seen lots of flows coming into certain regions, massive improvements in economic fundamentals, in, structural industrials, etc. And so for us, it's a region that we really like, and we can play this through, either buying local bonds, we can buy hard currency emerging market bonds, we can buy pure FX exposure through derivatives. And so for us, we tend to be very diversified across multiple different regions, spread our risk. We don't tend to have more than around 20% in the funds at all. In global macro, in the global government bond fund, it's a bit different because it's pure global government bonds. So we can do a bit more emerging markets. And obviously that won't be corporates, that will be either the government bonds or the quasis. But it's a super interesting market and somewhere that I think you do get paid for credit risk that actually is not as high as what markets price in. So another area that we're constantly looking at, and that's a really, great way that our funds can also add value, is being able to tap into these markets as well. So that's it from me, really. I hope that was helpful. I hope that was a good insight into sort of me, my life, my job, the funds that we run. And yeah, thank you so much for listening. Bye.